Hey, what's up, you guys? George here. Today, I want to talk to you about something that a lot of people are wondering about, especially when it comes to accumulating wealth, and that is how much do I actually need when I retire? Some people say it's 1 million, some people say 5 million, but how much do I need to live off of when I'm in retirement? And also, how much money can I withdraw in retirement? And so, those are some of the things I want to cover with you today. So, if you're interested, keep on watching. So, how much do you need in retirement? That's the key question. And oftentimes, I hear people talk about how much they would need is based on what they're going to spend when they retire. And they use very simple math. Like, for example, I'm going to need $1 million because I typically make 10% returns on my retirement account. I average 10%. So, I'm going to be taking $100,000 a year out of my retirement account because, again, I make 10%, and I'm going to be able to leave the $1 million in my investments because I'm just going to be taking out the interest, the 10% every year, and that's going to be lasting forever. However, the problem comes with the sequence of returns risk, or sequence risk. So according to Investopedia, sequence risk, or sequence of returns risk, is the danger that the timing of withdrawals from a retirement account will have a negative impact on the overall rate of return available to the investor. This can have a significant impact on a retiree who depends on an income from a lifetime of investing and is no longer contributing new capital that could offset losses. Sequence of risk is also called sequence of returns risk. What does that mean? So, the way returns work in retirement is different than how returns work when you're saving up for retirement, and that's major. That has a lot to do with your distributions when you start taking money out. And the second thing is that the returns are not the same. The average could be 10 or 12%. But each year is different. One year the market could be up 10%, another year it can be down 20%. The following year after that could be down another negative 12%, and so on and so forth. So the average that you are gaining while you're increasing, or when you're saving, could be averaging 12% or more. But when you start taking it out, that average is going to be significantly different based on every year that you're making withdrawals. So that's important to understand when you are trying to plan for retirement. And one of those ways that you can plan better, or more accordingly, is by doing an analysis. Now, there's also calculators out there that you can just Google sequence of risk calculators that can be helpful. Oftentimes, though, those calculators try to sell you something. So creating your own Excel sheet is going to be helpful. So let me show you what I created, and hopefully this will help you as well. So here's the sequence of returns risk model that I created in Excel, and it's pretty simple. Up here is the balance at retirement. So this is the balance that you're going to play with up here on retirement, which is going to affect this line item here. But let me go over the columns real quick. So the year right here is going to show you the historical year of the S&P 500 index. And this is with dividends, so that gives you a historical view here of what the S&P 500 did for that given year, all the way up to 2020 in this case. The amount of annual distribution is what you plan to take out. The percentage of annual distribution is what that percentage is. The initial investment balance and how that affects year over year based on how much you're distributing or taking out. And this is what the increase or decrease of the balance is based on what it did for that year. So a negative 3% is going to be going to affect your balance negatively $61,000. Increase with distribution, so it's the negative or positive increase on the on the return for that year, plus your distribution is going to give you that number, which will affect, again, your overall balance the following year, right? Because you're withdrawing your distribution plus whatever whatever the market did for that year, negative or positive. I also threw in the estimated Social Security because I think a lot of people don't take that into consideration. So I'm going to estimate a $5,000. It could be much less. It could be much more. It depends if you're married or single. So this is just an estimate amount. You can go to a website. You can go to the IRS website, and they can give you a quick calculator, and it can help you determine that. But I just threw that in. That's not really the focus of this video. Total annual income, and that's your annual income now. Now, in this scenario, I wanted to show you the dangers of just assuming you can withdraw 12% annually based on your past experience or past returns. So, for example, like I said earlier, I make 12% a year, so I'm going to withdraw 12% a year, and that $2 million balance is just going to stay the same. Well, again, because sequence of risk, each year is going to be different. We're going to use the S&P 500, for example, of the past 30 years to illustrate the dangers of just getting a straight 12% return or withdrawal rate by doing that. And you can see here how it's affecting it every year, the increase or decrease. And so when you do that, it's going to affect the balance. So the balance is going to change year over year. Now, it seems okay in the beginning, right? So from 1990 all the way through up to 2000s, you're doing good. But look what happens in 2000, 2001. You start to see it really starting to take a hit. And then you go all the way down to 2008, where it really took a big hit. And you see your balance start to significantly drop. And then you keep going, and you see here by 2013, or by 20 years into your retirement, you are depleting your retirement overall. So instead of forecasting for 30 years, you're going to forecast for approximately 20 years. And so it's going to be negative. Of course, the calculation just keeps going negative, negative, negative. So you're not going to be able, you're going to run out basically out of money by, your 24th year. So that's the dangers of just having a fixed percentage. And see, this is the fixed percentage, 12% year over year. Again, because it's not a fixed return every year, it's going to fluctuate, and so that's where the sequence of risk is vital for you to understand. Now, so that's the 12% year over year. So that's just a scenario, just to illustrate again the risk of just having a 12%. Now, there's people out there say there's a 4% rule. Use a 4% rule, but that might be too little too. 4% might be too little, and you're leaving a lot on the table. Maybe you don't want to leave as much to your family or what have you. You want to do a little bit of both. You want to be able to spend just enough to live a comfortable life in retirement, but also you might not want to leave too much. You just want to, I would always say balance it out. So what do you do? Well, here's what I recommend. So here's an example down here where it fluctuates, right? It fluctuates, the percentage of annual distribution fluctuates every year. So in this case, what I did is I plugged in the what I think is comfortable to live off of. So you've got $2 million, I plugged in $100,000 here. Before, you see here is $240,000 every year. That may be too much, and obviously it was, because it wasn't enough for a full 30-year retirement. Now, of course, you can argue, 30 years too long, 20 years enough. I mean, that's also something to take into consideration. But traditionally, you want to plan for at least 30 years into retirement, 30 years of retirement. But anyway, so I put $100,000 as a comfortable distribution in this example, which Social Security gives you an annual income of $105,000 on $2 million. Now, if you see here with the same, 1990 through 2020, it's using the same returns. We're just going to use those as an example to try to forecast in the future. And that's another thing to consider, is that we don't know what's going to do in the future, so that's another, something to consider. But because we shouldn't base everything on past performances, but we got to start somewhere. So at least this is a starting point. Anyway, so we've got 2 million here, and you can see how the sequence of distributions right here are going to affect it differently, because the distribution rate are going to be different. See how some years it's going to be 3%, some years is 1%. And so this is, to me, a better way to plan your retirement, is by taking a fixed amount, and then depending what your what your retirement balance is, pick a fixed amount and see how that affects your retirement. And in this scenario, you can see how it's actually going to grow based on the returns for this 30-year period. It's going to grow, and it's going to actually leave you, in this scenario, 18 million by your 30th year, and you're going to be taking $100,000 every year. So that's something to consider. Withdraw what's comfortable for that year. Have a very basic cost of living as far as what your budget's going to be, insurance, cost of living, or what have you. Have it just be the minimum. Just have a minimum, what you'll have, and just try to cover that. And then anything extra that you gain for that year as you're making distributions, just take that extra and try to budget that out for that year. And if you have extra left over for that year, splurge a little bit, have fun a little bit for that year, but always have a baseline income. And of course, try to be as conservative as you can as far as your estimations, because the way I see it is better to weigh in the side of caution versus trying to push the limit and really try to get the most out of the bang for your buck, if you will, when it comes to retirement or in retirement, because you could always just cash out at any time that you want, and I don't mean the whole thing. I'm just saying you have more control year by year. So being conservative and then cashing out, lump sums as you need will be better. Of course, you got to take into consideration taxes, what your taxes are in your state. So all those things are something to consider. But doing an analysis of something like this, which again, just use Excel, you use some numbers from past history of the S&P 500 index, or use calculators that you find online that would be helpful to help with the sequence of risk, sequence of return risk. That's all I have. Hopefully this was informative or helpful. Please consider subscribing. We really appreciate your support. That's all I have for this one. We'll see you on the next one.